Hello, this is Brian Lysing with Financial Brokerage, and today I'd like to talk to you a little bit about the hidden tax in your client's buy-sell agreement. Now, I have this conversation probably every week with an agent or advisor working with their business owner clients on policies to cover their buy-sell agreement. You see, many business owners are not aware of the hidden tax in this buy-sell agreement, and this could cost them an extra 15 or 20% when they decide to sell their business. So what is this tax? How to get there? And most importantly, is there a way to avoid it? Well, here's your quick answers. It's the capital gains tax. It's there because the owners did not set up their buy-sell agreement the right way, and yes, you can avoid it. So what does the capital gains tax have to do with the buy-sell agreement? Well, many businesses with multiple owners set up their buy-sell agreements in the simplest way possible. The business agrees to purchase back the shares of any owner who passes away. They usually fund this with proceeds from a life insurance policy owned and paid for by the company. Unfortunately, this arrangement also increases the chances the remaining owners will have to pay capital gains taxes if they eventually sell their shares of the business. Now, this is easier to understand with an example. So let's say we have two people who start a business and each contributes $50,000 to the business. So our business is worth $100,000. To keep things simple, let's assume this business experiences no growth and no losses. So the value remains $100,000. If one of our owners passes away with the simple plan, the business receives the death benefit tax-free and can turn around and pay off the deceased owner's family right away. A remaining owner now owns the entire business, still worth $100,000. We haven't incurred any taxes yet, but what if this owner decides he can't go on and do this by himself? He doesn't want to bring another owner into the picture. He wants to sell the business completely. So he goes ahead and sells the business for its actual value of $100,000. But wait, his basis, the amount he put up for the business initially, was only $50,000. That means he has to pay capital gains tax on the other $50,000. Now that really doesn't seem fair because the value of the business never changed, right? He never actually made an additional $50,000, but he has to pay taxes on it. So how could our business owner avoid this capital gains tax? Well, the owners could have set up their buy-sell agreement as what's called a cross-purchase agreement. Each business owner owns and pays for life insurance on the other owner's life. That way they personally receive the death benefit tax-free and can pay off the other owner's family with their own personal money, not the company's money. Now the remaining owner has increased his basis in the company from his original $50,000 to the full $100,000 value. If he sells for exactly $100,000, there is no capital gains tax. Now hopefully the business is profitable and there are capital gains, but those would come from actual growth. It would be pretty disheartening to pay extra taxes when no growth had occurred. Now how can you use this with your clients or to obtain new ones? Hopefully you can use this information going forward with any new buy-sell life insurance business you encounter. Better yet, you now have a reason to review every buy-sell life insurance policy you've ever sold to see how it was arranged. Now, even better than that, this is a great conversation starter with any business owner if you're prospecting for new business. So just ask the owners if they are aware of the tax hiding in their buy-sell agreement, and then call us at Financial Brokerage and we can walk you through the rest of the process.